Hey everybody, Chuck Barone. It's Wednesday, December the 6th, 2023. Man, things are getting crazy, guys. I'm looking at some of this stuff today. Not a lot of data today, but it gave me some time to kind of think a little bit, do a little bit of digging. This new study that I found was interesting. We're going to get into a lot of interesting stuff to give you guys some things to think about today. Anyway, before I get started, let me, of course, welcome everybody to the show. And as always, thank you guys for your support. You guys keep coming, keeps us going every day, man. We appreciate you guys, really do. All right, so let's talk about the markets today. So the markets are convinced the Fed's done raising with their rates. You would think this would have the markets celebrating. It kind of isn't. I guess there's not a lot of real certainty yet, but the bond market seems to be doing it. The bond market believes that there will be no more hikes. They're already pricing in cuts all over the place for next year, some as soon as February or March. So there's a lot of uncertainty in the markets and there's a lot of data coming, big jobs data coming in the next couple of days. So the market's kind of taking a breather today. Stocks falling across the board. The Dow goes down 70 points, down 70, 36,054. The NASDAQ down 83 points, 14,146. And the S&P down 17 today, 4549 on the S&P. And these are still pretty lofty levels for these indexes, but I think the market's feeling like, maybe like I was saying yesterday, the idea that we're going to have everything's just going to work out perfectly. Well, who really believes that? Who's seen that in real life? I haven't. So we'll see. I think that a lot of data coming, some stuff that I've been digging to find out here, just some ideas and some stuff I've heard from other people to kind of get a little deeper into it. So it's going to be interesting times coming up, an interesting finish to the year. Everybody waiting for the Santa rally, and it hasn't really materialized. The whole year's kind of been a rally, I guess, but no big December rush, at least not yet. The bond market today, mixed, with the 10-year falling 5 basis points. So that 10-year now down to 4.12%. The 2-year actually up today, so 2 years are selling off, but only up 2 basis points, sitting at 4.60%. So these are still really, compared to where they've been, these are very low numbers. You know, the 2-year is probably down 0.5 point in maybe the last 10 days or so. So it's just the bond market adjusting to their imagined reality. And I got a feeling we could see some serious whipsawing with rates. I say rates, I guess that's the habit I have from being in the mortgage business for so long. With yields up and down and all around like they have been. We've been talking about that on the show. You know, when you're seeing moves in the bond market of 20 basis points in a day, when you're seeing, moves in the bond market of 15 points in a day, these are not normal moves. This is not the way it normally works in the bond market. So I think we're going to have continued volatility there. And I think some investors agreeing with me on this, as you see the dollar now back up over 104. Now remember, guys, when rates are on the way up, that strengthens the dollar compared to other currencies. So usually when rates are on the way up, the dollar rises. When rates coming down, the dollar falls. Now the dollar peaked out, a while ago. It was around well over 110, let's just say. I think it was around 114. And now back down to reality, but not quite. Still a pretty strong number for the dollar index. What is this telling us? Currency traders probably thinking, well, rate cuts might be we might be a little over enthusiastic as far as getting rate cuts so quick. Metals today, another weird mixed day for gold and silver. Gold rally is up $6.30, now $22,025.10 for an ounce of gold. Silver falls down 27 cents today, 23.87. Silver seems to be looking like it's getting into bargain territory to me. I think that the rising dollar affected silver today. Gold's just on a real bull run right now, consolidating over 2,000, guys. Crazy, right? So gold and silver, I still feeling pretty bullish about them. And we'll see if the dollar comes back down, and it ultimately will. Once the Fed gets to cutting rates, you're going to see a pretty big rally in gold and silver. Oil today. Wow. Big day on oil, falls another over $3, $3.07 today. A barrel of West Texas Intermediate now $69.25. So it's even below our target. I was telling you 70 to 75. I still believe that's where it wants to trade. But the correction underway. We got some information. I guess stockpiles in the U.S. are a little bit higher than they thought they were. Boom. Oil, the markets react immediately. So we'll see. It's, like I said, I get comfortable with the idea of 70 to 75 a barrel. I think that that's probably where it's going to trade for a while. Sadly, we're not really seeing it reflected too much yet at the gas pump, oil greed people. You know, you guys are instantly raising gas prices when oil goes up even pennies. Now it's coming down dollars. Where's the relief, guys? Anyway, Bitcoin today. Bitcoin consolidating, coming down a little bit today, down just $77, sitting at $43,813. Massive rally, and consolidating at these numbers. It doesn't look like this is some kind of whipsaw where it's going to just shoot up and come crashing back down. Let's see where it goes. We'll keep an eye on this stuff. All right, so we know tomorrow we got a big jobs day. Friday jobs for last month. Tomorrow unemployment, consumer credit, some other really important consumer data. Today we got a little bit of a report comes out about payrolls, private payrolls, coming in softer than they expected. They were expecting 130,000 increase in private payrolls. They only got 103,000. That's a pretty big miss. So this is more good news for the Fed and the people who are hoping and wanting rate cuts. The job market obviously softening up a little bit, because usually these experts were way undercutting the numbers that were coming. Now they're overshooting, so this tells you the trend is changing, right? And this has been the Fed's target. This has been what they've been looking at. This is what they believe is driving a lot of this inflation, is the hot jobs market. New jobs want to recruit good people, typically going to pay a couple dollars more. Those wage gains drive the whole market higher, and the Fed believes that extra consumer discretionary money going into people's pockets leads to this inflation we've been seeing. I don't know. I think you got a combination of things there, and I would not discount greedflation, because we know corporations have been, they have their opportunity to raise prices. They could do it without getting a lot of pushback from consumers. But now this inflation's pretty much done, except for now you're seeing the greedy corporations who refuse to, prices are still going up on stuff I buy all the time. So a lot of conflicting stuff, right? But I guess, when you have price of used cars, big ticket stuff coming down, durable goods, used cars, electronics, stuff that's bigger ticket stuff coming down pretty dramatically. That does a small increase in butter, doesn't show up so much. But we know about it, those of us who buy groceries, right? So that's going to be interesting to see now how this jobs thing finishes up tomorrow. The market I think there's some uncertainty. We'll see. Going to be interesting to finish this week. Another study. This study today was the one that made me sad. Study shows 80% of U.S. households are now worse off financially than they were before the pandemic. Cash savings falling below where they were before the pandemic. Even with all the stimulus checks and all the no payments to make and all the stuff that they did, consumers saving at a pretty huge clip back then. There really wasn't much place to spend your money. Well, that's all gone now, guys. Okay? And this explains, in my mind, the disconnect that we see all the time between what the public, not rich, the public, the working people, us, the schmuckatellis, and what we are feeling and thinking, and what we're getting spoon-fed and shouted at by Washington, where they want to make us think everything is great and getting better. Even in it, I mean, they want you to believe, remember the old Marx Brothers line? Who are you going to believe? Me or your own lying eyes? Well, that's kind of where we are now. The government wants you to believe everything's great. At the same time, the public drowning in debt, seeing prices on everyday stuff go up like crazy, trying to find a way to make ends meet, because even with wages and take-home income going up a little bit, well, so is interest rates, right? So payments on credit cards. If you had a balance, guess what? You're paying more on that balance. So the public getting a little bit sick and tired of hearing how great everything is, when their actual everyday life tells them things aren't. So let's add all of this stuff up, guys, okay? You got still persistent inflation, especially on consumer goods, food, and stuff like that. You got the jobs market softening. You got the Fed keeping rates high. You got the real estate market ready to completely go upside down. Commercial real estate, haven't heard much about that lately, but we know there's a tsunami coming there. And now they want to tell us, in spite of all this evidence, that we're going to have this perfect soft landing, and we're not going to have a recession, and everything's going to be perfect. Tells me that I'm probably right. We're not going to get out of this without a recession. This is all adding up to everything that causes a recession. Broke consumers, high interest rates, jobs going, job opportunities going away, prices going up. People can't afford even to pay their bills, let alone buy the necessity or the extra stuff in life. Going to be a fascinating year. And now as we move into this election year, it's really going to get hairy. And this is my own analysis. I was really thinking, I want to have something interesting to talk about every day during this show, other than just the data. Looks to me, guys, like we might be forming the biggest credit debt bubble in the history of the world. Think about it. Everybody maxed out, man. Look at the government. Let's start there at the top. 33 trillion and climbing fast. Look at your state government. How many states are operating in surplus? Only the ones that are mandated by their constitution to have a balanced budget, like Nevada. California, not so much. New York and other deficit states, right? You got corporations in debt up to their freaking eyeballs. The banks looking at some serious delinquencies, especially with commercial real estate unwinding the way it is. You got consumers racking up levels of debt that are unbelievable. And now, listen to this. I got an offer the other day for a credit card. It was great, man. It made me laugh. They're going to give me 6 months of interest-free. So they want to give me 6 months of credit with no interest rates, balance transfers or whatever. And after that, after the 6 months, my interest rate would only be 30.7%. What a deal, man. Guys, remember one thing. Bubbles, they can get humongous. They can get very, very, very big. But they always end the same way. There's always that pinprick, and either the air comes out slow, or it goes boom and comes out real fast. But bubbles only end one way. Anyway, guys, that's it for the day. As always, we appreciate your guys' support, man. You guys mean the world to us. I hope these videos are being beneficial to you guys and a little more than entertaining. Please, if you can, if you got a second, hit the like button. It changes the algorithms, gets our video out in front of a few extra people. We'll be back tomorrow to talk about jobs, and finish up this crazy week as we're heading toward the big finish for 2023. Anyway, guys, that's it for the day. We'll be back tomorrow. Till then, take care. Thanks.